Good morning, everybody. It is Monday, April 21st. Hope you all had a happy Easter. We are going to start our prep today for the ES, and we will give out some NASDAQ levels here. First, just a quick reminder that derivatives trading is inherently risky and past performance is not indicative of future returns. Now, with that being said, we're going to start off with looking at overall volatility and positioning in the market. So if we look at where we are, commercials have gone back to net long on the S&P as well as on the Dow. And we are net short commercials on the yen, soybeans, and then net long on oil. Now remember, they have to make the market in these, so we watch and then we use our levels for supporting those cases. We typically see when they are building positions that it takes multiple weeks, not just a single period or single week. And we see that when we look at our overall charts, that these positions take a lot of time to build. So we can see that on the S&P here, that the short position took quite a while and then it played out. So they started building this back in October through the end of the year into January and February, and then the market came back down to lows from last April and beyond that. So we always want to check into these. We can also look here at the yen, as that has been giving a signal as well. And we are getting, again, this short position that we haven't seen in multiple years. So we want to be aware of that as the dollar is getting devalued, and Trump does support a weak dollar as he did in his first term. That pushes other currencies up. That's why we've been saying that the 6E and the 6J are at least the 6E and the 6B are good longs. On the 6J, it has been a good long, but we want to be cautious as the positioning is saying we could see a short-term shakeout coming in the next couple of days or in the short term, as commercials will look to reposition this because they will take on so much risk on their books and then we'll shift that risk around. Speaking of risk, we always want to check this on other assets as well. So if we look at high yield, and this brings in credit risks for companies, we haven't seen this since 2020 into 2022, and now where the inversion of this and these spreads is signaling that there is credit risk and default risk, which we want to be aware of that with earnings season starting. This will affect bank balance sheets because if companies start to go under, that would affect the loans, whether it's small businesses through SBA, through regional banks and local banks, or if it is smaller cap publicly traded companies that will bleed into the larger banks. And so we want to watch this because this is what played out and led to that bear market, that credit risk, that balance sheet recession that we have as a potential. And that is what started kind of that bear market in 2022, although the Mag 7 helped prop us up and keep us out of that. The small cap, and we can look at the Russell and see was where the real risk was. And that's what we're going to watch here as this signals more small and medium cap risk. On to bonds. In the short term, we are getting a pullback, but we are trending higher. We want to watch this as higher volatility in the fixed income space can bleed through to the currencies and the equity markets. And so more volatility here means more important on the bond auctions, which we have 3 auctions today. So be sure you're paying attention to your catalysts as those yields will directly affect positioning as people have to reposition money from one market to another, basically pouring water from one cup into the next. So we want to pay attention to this as we have the auctions today and earnings season starting, as well as then the 2-year tomorrow. And that's going to be a big one as that signals more anticipation on Fed rate cuts or no rate cuts as we approach the next Fed meeting in a couple of weeks. Looking at overall volatility across multiple asset classes here, we are seeing a rise overall in volatility. And so until we see the VIX get back under 30 and really under 20, there is a lot of risk in the market. And so any kind of rally is going to be more short term until this equation changes. We can look for both sides as for day traders, we are looking for very wide ranges, very big moves. But if you are a longer term investor, this is where we want to be more cautious. The other thing we pay attention to is margin trading, and it hit its excess point in December. And we have seen margin balances begin to shrink. And this is what we saw in March of 2020, June of 2007, and March of 2021. All were preceding 6 months to 9 months in advance of a downturn in the markets. And if this started here in November and December, where we were up in that 40% and the 90th percentile, that signaled again 6 months, 6 to 9 months in advance, which puts us right around that May, June time, which is where we are for that downturn. So we're going to watch this closely because if people want to stop borrowing money to trade and are less willing to trade on margin, then that is going to shrink the bank balance sheets. That's going to put a liquidity drain into the markets and signal even more downside coming. So we watch this regularly to know where the balance sheets are and where margin trading is. And this is, again, just another thing that we are paying attention to as we have seen these bounces that are great for selling opportunities. And then when we look at our algorithmic and risk mitigating strategies, they are nearly flat equities. And when the red is above the green, that is usually a bad sign. We always have to look in context for where it is in which zone we're in. We need to get under this lower zone here to get any kind of sustained rally, because when we are in this upper zone, again, that pressure stays to the downside, which we saw back in 2022 and we are seeing now. So even if we see the VIX drop or volatility come down, it's going to take several weeks for this to reposition. So even as we saw a multi-day rally in the last week or so, we saw a multi-week rally in 2022 that still led to a new low into October. We are looking for new lows here for this year, that the low is not in yet and that we're not out of the woods. So we want to pay attention to that positioning. So with all that being said, the upside is going to be limited. They are going to be better short opportunities if you are a long only trader or can only trade long if you're trading in your retirement account or can't trade on margin, then this is not the asset to be looking for. You can look for daily, but equity indices won't be where to look. You're better off looking at other currencies like the FXE or 6E, depending on if you're trading the ETF or the actual futures, or looking into the commodity space. Gold has been making new all-time highs, and we are starting to see retail begin to jump on that bandwagon. So we should see a continued breakout here in gold, just waiting for pullbacks to buy into. And that's been our plan this last month. So now for our levels today for the ES, and we can go for our professional subscribers. We are still adapting some of our tools, but we do have the ES where it does have our levels on here for you, so you can see them, and then you can see the line in the sand as well, where that is. And we are under our line in the sand, which again brings in more risk into the markets. We are also under our minor line in the sand. But we can see our levels here. To see them a little more close on the chart here, we are looking for rotational price action 53.44 to 52.42 with our pivot at 52.90. If we break out of our rotational zone, we're looking for 53.90 or 54.30 at the top end, and on the lower end, 5200 down to 51.70. And if volatility breaks out, so if the VIX gets over 35, then this will expand and we'll be looking more for 5110 to 5111, as that will tell us that there is more downside in the market, but all else being equal for this morning, no major shifts. These are going to be our levels. And then on our website, again, just for those who have the tools, we can look intraday, and you can see with VWAP, you can toggle this on and off, as well as the minor levels, and you can see what you want to look at. So our minor line in the sand is still above us here at 54.73. So even the top of our range says we won't get there today. Repositioning can happen, but on that lower end here, we are looking for that lower band 51.99 to 51.69 with our lower support at 51.24 to 50.50 from our market makers. And then again, you can toggle these on and off for our major and minor expectations. You can put VWAP on and off so you can see the relation in the distribution for the day. And you can also turn off the values. So when you're moving over this, those don't show up. So we also have other tools for you, as well as our gamma curve and different strikes that you can look at if you want to pay attention to where the options market is going to look for liquidity. So that is what we have on our website for our professional subscribers. And then for the NASDAQ levels here today, just very quickly, we'll round it out. We are below our rotational expected lows, so we can look for a trend. 18,133 to 18,537 is our rotational. Breaking out of this, we're going to look for 17,922 and 17,763. Again, if the VIXN begins to break out, then we will look for an expansion to that bottom end of the range. That would have to be over about 38 on the VIXN to see it actually begin to push into 17,600 and 17,500. But that's what we watch as we want to understand where these risks are and how traders are positioning. Other big catalysts this week to pay attention to are going to be the earnings. Tesla begins earnings this week, as well as Google. And then next week is really when we get the big hitters. We hit month end, and then we hit Apple, Amazon, Meta, and Microsoft earnings. So those will all be things to pay attention to right ahead of the next Fed meeting, which Trump is calling for rate cuts, and the Fed so far has signaled that they're going to stay more flat and wait to see how tariffs play out. So we will pay attention closely on that 2-year auction tomorrow for what the bond market is looking for, and continuing to watch the 2-year yields throughout the next couple of weeks for any signals of traders putting on bets or taking off bets and where that crowded trade happens. So be sure to control your risk out there today, guys. It's still going to be a more risky environment with bigger moves, bigger stops, but also bigger opportunities. So be sure to control your risk, as that's the one thing we control in this game. And have a great day, guys.